All right, let's talk about Invesco's latest earnings call for the fourth quarter of 2025. Now, at first glance, things looked pretty messy. The stock took a hit, and the headlines were not great. But if you dig just a little deeper, you start to see a much stronger story taking shape. So let's get into it.
Here's what we've got on tap. We're going to look at what the numbers said versus what they actually meant. Then we'll cover management's game plan. We'll try to figure out the market's weird reaction. And finally, we'll give you our call on where things go from here.
Okay, first up, earnings versus expectations. And really, this whole quarter was a classic battle between some pretty confusing accounting noise on one side and some seriously strong business momentum on the other.
I mean, it's really a tale of two completely different stories. The headline that everyone saw was this massive, scary-looking loss. But the real story, the one that tells you how the actual business is doing, that was a solid beat.
So here's the number that sent everyone running for the exits. A GAAP loss of $2.61 per share. Now you have to understand, this was almost entirely because of a huge one-time non-cash charge. We're talking $1.8 billion on paper. But, and this is a big but, once you strip all that accounting noise out, you see the real number, an adjusted 62 cents per share. And that didn't just meet expectations, it handily beat the 58 cents analysts were looking for. So from a pure business standpoint, Invesco actually had a great quarter.
And hey, the proof is in the pudding, right? Just look at these numbers. Revenues up almost 9%. Assets under management hitting a record $2.17 trillion. They pulled in a massive $19 billion in new money. And look at that operating margin, way up from last year. These are not the numbers of a company that's struggling, not at all.
So, if the business is humming along, what's the game plan to get the stock price to reflect that? Well, that takes us to what management is doing behind the scenes. And their story is all about unlocking value.
It really boils down to three key things they're focused on. Number one, and this is a big one, is the modernization of their famous QQQ fund. Number two, they're simplifying the company, selling off pieces that aren't core to the business. And number three, they're cleaning up the balance sheet.
Okay, let's just pause on this QQQ thing for a second, because it's a huge deal. For years, Invesco ran this absolutely gigantic fund and made almost nothing from it. It's kind of crazy. With this change, they have literally just flipped a switch on a massive new revenue stream. It completely changes their earnings power going forward.
And you don't have to take my word for it. Listen to the CEO, Andrew Slober. He's basically saying 2025 wasn't about putting out fires, it was about transforming the business from the ground up to set the stage for real, profitable growth. You can just feel the confidence there.
And look, they're not just talking a big game. They're putting their money where their mouth is. They bought back $500 million in stock, paid down debt, and sold off 2 different businesses. These are real, concrete moves to make the company leaner, simpler, and financially stronger.
So, let's recap. We have great operational numbers and a super clear strategic plan. You'd think the stock would be soaring, right? Well, about that. This brings us to the most confusing part of this whole thing, the market's reaction.
Seriously, this is the million-dollar question. Everything we just looked at, the earnings beat, the record assets, the QQQ game changer, all of it screams buy. So why on earth did investors slam the sell button?
And here's the damage right here. The stock opened down and just kept on sinking all day, closing down more than 5%. That's a pretty clear thumbs down from Wall Street on earnings day.
So what gives? Well, it looks like the market just couldn't see past that big, scary $1.8 billion charge. The messy headline number completely drowned out all the good news. It's a classic case of a knee-jerk reaction. Sell first, ask questions later.
But when you see a disconnect like this between a scary headline and a strong reality, that often spells opportunity. And that brings us to our favorite part of the show, our official prediction for what comes next.
Okay, here's our take from us here at Talk Tickers. For the first quarter of 2026, we're penciling in 64 cents a share. The big reason, they'll get a full quarter of benefits from that new QQQ structure. We think that's going to be the wake-up call for the market, leading to a positive re-rating for the stock. The thing to watch is those ETF inflows. If they keep that momentum going, it's just more proof that this story is the real deal.
So when you put it all together, strong fundamentals, a much cleaner balance sheet, and that brand new QQQ revenue engine, for us, it's a clear outperform. Ultimately, the ball is in the market's court. Management has done the heavy lifting to transform this business. The business itself is firing on all cylinders. The big question now is, will investors finally look past the accounting smoke and mirrors and reward the actual growth story happening underneath? We'll definitely be watching.
And as always, just a quick reminder, this is not financial advice.